All right, let's get started. We're at 12:02 here Eastern. Welcome everybody. Pablo Dominguez with Insight Partners. You're joining a webinar today about sales KPIs for sustainable growth and winning in 2023. Want to introduce our guests. So again, Pablo Dominguez, I run the sales and customer success team here at Insight Partners, supporting our portfolio companies. And rather than just hear from us, we decided to invite two of our distinguished CEOs across our portfolio, Neha and Jordan. So Neha, if you could start by introducing yourself and your company, we'll get started.
Sure. Hi, everybody. I'm Neha Sampat, founder and CEO at Contentstack, which is the next generation of content experience platform. And we are about 450 people now worldwide in 16 countries and 29 US states. And we are now our third partnership with Insight, who led our A and participated in both our B and our C as well. And we just closed our C round about 2 weeks ago. So it's been quite the journey working with Insight, and we are super excited to be here and would love to share what I can and hope it helps.
Cool. Thank you. Jordan.
Hi, everybody. I'm Jordan Rackie. I'm CEO at Keyfactor. I've been with the business for about 3.5 years. Insight's been in the business for about 4. This is my third Insight-backed company, so I've certainly enjoyed partnering with Insight over the past 6+ years. Keyfactor is a cybersecurity business focused on machine and device identity management. So in an enterprise ecosystem or network, you've got all sorts of data that needs to get communicated. And there's been a huge investment historically on protecting human identities, but devices and IoT is actually a much more sizable part of your network than humans are. And so we help enterprises solve that problem. We have about 450 employees, about 1,300 customers worldwide, have had and experienced pretty good growth over the past 3.5 years or so. And excited to be here today and talk about very pertinent topics around sustainable growth. So thanks for having me.
Awesome. Thank you both. Yeah, and given your roles at your companies and how you've scaled those companies, I think what you've got to share here with the broader community will be very pertinent. So what do we have on the docket today? So one, we'll give you all an overview of what we mean by Insight Scale by the numbers. We'll talk a little bit about why sustainable growth is so important right now, as we all know what's going on in the economy. And then we've taken 3 critical KPIs from our Scale Up report, and we'll give an opportunity to Neha and Jordan to basically dig into those and help answer some of the questions that you all submitted. So we received over 150 questions from those of you that are on the webinar or maybe couldn't join, and we'll take the recording. So we will have the recording shared with you all afterwards, but we've tried to pick some of the most pertinent questions from those of you that submitted. So thank you all for doing that. You also have the chat feature within Zoom. So if something pops up that we're talking about, or you want to ask a follow-up question to Jordan or Neha, I will do my best to try and capture that given the number of people that we have on. Otherwise, we'll try and answer it offline. So a little bit about Insight Sales Scale Up by the numbers. So this is something that we released this summer. For those of you that don't know much about Insight, we're a PE VC firm that focuses on software investments in high growth companies. And we've basically taken all the data that we have from our portfolio companies and are sharing that publicly with the rest of the ecosystem so that you all can get one, the investor's point of view, but also the operating point of view. So if you went to insightpartners.com and you go to the blog section, you can access the full report. This is free, it's not gated. So we're basically just providing high-level insights across various KPIs for early stage companies, mid-stage companies, late-stage companies. So depending on where you are on the journey, you're able to see what CEOs, investors, and Insight basically has to share. So we'll be focusing on some of those KPIs here. So why sustainable growth, right? And why efficient growth? And so we might have heard, in the markets, the grow at all costs from 2020, 2021, and really the shift is happening now, or hopefully some of you have been operating your businesses in a way that is really more about sustainable growth, right? As we get headwinds in the economic environment, and especially in the tech sector, you're seeing a lot of changes that are happening in real time. it's even more important to think about how to drive sustainability in your business and efficiency. So before we go into some of the KPIs, wanted to, kick it off to Neha. As you as a CEO go into, the new fiscal year, how are you thinking about shifting your strategy, where your team focus is to really ensure you have a responsible growth plan for your business?
Yeah, thanks. It's interesting with headwinds, and we've seen this before. This is probably my third kind of economic pressure environment when I've been a CEO. And we recently saw it at the beginning of COVID as well. It's really just kind of shifting the narrative and understanding what your prospects and customers are going through, and then ensuring that you're shifting how you're bringing value. And so we've really looked at just having the focus be more on return on investment, really focusing on value that the product brings to a company, how that helps them connect with their customers and stay relevant, and just overall the total economic impact of what Contentstack can do for a brand. And so that's important from a customer point of view. And then just from an internal operations point of view, it's really important just to keep a really close watch on deal cycles and pipeline, and just be careful about growth, right? Do it in a deliberate and just meaningful way. So those are kind of the things top of mind.
That's good. Let me ask a follow-up question before I go to Jordan. How do you balance, a couple of months ago, you guys might have been thinking about how to scale in 23 or 24. And now with the changes, are you all potentially shifting things, reprioritizing, and how do you prioritize as you go into the new year?
It's interesting. I've always thought about building in a sustainable and deliberate way, and I think it might come from 10 years of bootstrapping companies. So I'm probably one of the most frugal CEOs on the planet, which my team is probably smiling and laughing now. So it's kind of like business as usual for the most part. It's just thinking about what are the pain points that customers are facing, and how do you make sure that you're addressing those pain points, rather than really shifting how we run the business, if that makes sense.
No, absolutely. That's great. Jordan, what about you and the Keyfactor team?
Yeah, I think for us, as far as, how do we go into 23 thinking about it a little different? We've experienced, 50, 60% growth year over year, the past 3-4 years. And that's not just on, customer side, but also on employee base side. So we've been making investments. We've been bringing in more resources to the company. So when we looked at the end of the year and we saw kind of the headwinds that are out there, one of the realizations we noticed was that, on average, we'd have about 30 to 40% of our staff that was still in a kind of a ramping phase in the organization. So, making some assumptions there, of course, but, if it takes 6 to 9 months to get an employee on average to, full productivity, we're looking at the growth that we're trying to sustain going into next year, not slowing down on kind of that top line performance, but also being conservative, fiscally and responsibly as it relates to investments and more resources. And we believe that, because we feel like this is more of a window than a long-term kind of headwind scenario, that we can allow, kind of those that are still ramping the business, invest back in them, invest in our team, increase the productivity per employee. And that can help us as we kind of weather this kind of, 2022, late 2022, 2023 climate. And then hopefully by, mid of end of next year, those headwinds are turning around to tailwinds, and we can make more investments into our team. We certainly don't want to be in a position where, people on our team are feeling overstretched or, strained. So we're monitoring that closely. But we also believe that we just, we have that tail of kind of ramping resources that we're just going to allow them to catch up. And that's going to help us as we kind of, move through the next like 9 to 12 months.
Yeah,
No,
can I add to that? Actually,
go ahead, Neha.
I think that's a really important point, Jordan, is like in this environment, it's also just thinking about the focus and figuring out how do you do the right things, and how do you get comfortable saying no to certain things. And so there's sort of this constant what's in, what's out conversation that happens as a leadership team. And it's really hard as an entrepreneur to say no to things. Like you get used to just wanting to do everything and just pleasing everyone. And part of the responsible growth element is really learning when you can say no, or just put something aside for later.
And I would say also from a deal standpoint, I mean, we're looking at, the profitability of different types of deals. We do everything from $5,000 a year deals to multi-million-dollar a year deals, with a sweet spot, somewhere between 150 and 250K in ARR. But there's certain deals, certain types of deployments that just are not nearly as profitable for us. So what are we doing to address that? What are we doing from the sales standpoint? We're incentivizing certain behavior, we're incentivizing multi-years, we're incentivizing certain types of deployments. We're incentivizing reps by higher percentage payouts if they aren't discounting certain levels on certain contracts. So there's different things that we're trying to do there as well, just to make sure that the accounts that we are targeting are ones that are going to be a very profitable outcome for our business, which leads to sustainability in this environment.
That's awesome. Thank you. So as CEOs, and this is a point that we got here on LinkedIn in terms of, spot on, people want to measure everything all the time and end up driving KPIs that aren't even relevant to their stage of the journey. One thing you might be asking is like, well, hey, how did you get to the KPIs that we're going to go through here? Wanted to share some analysis from McKinsey. This is a slide that Nick made at Gainsight and I actually presented at Pulse. And so if you look left to right, you've got a lot of metrics that are low correlates, medium correlates, and on the right, you can see what are highest correlates to strong enterprise value, right? And so you can see net retention, obviously that's a focus from the CS side, payback period to the top three. So those are two things that we'll talk about today, just given the relative importance to really focus on strong enterprise sales. So let's go to the first metric on customer acquisition cost and CAC payback. And so what you see here, and just to reinforce for everybody on the call, in case this isn't something that you're fully aware of, customer acquisition cost is what it costs you to acquire a customer from a S&M perspective, sales and marketing, and then CAC payback is how long it takes you to recoup those dollars that you invested. So you can see the formulas there. Again, on our Scale Up report, a lot more detail into what this looks like across 300 companies and by stage. But a couple of questions that came into this. So Jordan, let's start with you on this one. How do you optimize sales and marketing spend? Where were you willing or not willing to sacrifice?
Yeah, I mean, for us, optimization again comes back for us to productivity per rep and just making sure that we're looking across the board of our team and making sure that we've got A players, people that I think in this market, in some markets, in some climates, you could do fine with certain sales reps that are, I don't want to just say are order takers, but are more coordinators of deals and making sure the ball doesn't get dropped, which in certain climates, certain economies that works. I think right now, I've really challenged our sales leadership and team to, just have a acute view on making sure that we got resources that drive deals, that influence, that motivate, also are very empathetic as well. But ultimately, you've got to have people, you have to have the right people in the right seats. And I think, this climate calls for people that, are more evangelists to make sure that, that can happen. And then, selling back to the base as well, you've got to have people that, know how to have those kind of farmer relationship types and can't just be kind of out there, hunting with spears or whatever. So, that's one thing there. The other thing I would say is what we look at, we have a formula. It's we do a power ranking of all of our salespeople. So it's not available to the reps or anything, but the ones that are watching are probably going to try to figure out how to get it. But it's, it's a combination of kind of their base salary versus their attainment, the amount of performance they've done from a booking standpoint over the past 12 months, and then their kind of next 6 month, mid and late stage pipeline. And we do like a weighted formula, and that helps us determine, the resources that are lasting versus not. I would say we have a great retention strategy at our company too, so I don't want to make it sound like it's a doom and gloom thing, but you got to optimize. You got to make sure that the company's not just pulling along resources. It's a bidirectional value case, right? You want great resources, and the company's got to provide back to those resources as well. So, I mean, those are some things we're doing. From a marketing standpoint, I think agencies, go a long way to support kind of the ebbs and flows and kind of bandwidth, requirements that we have for any sort of productions. And then what are we not sacrificing? Like, to me, we can't sacrifice, our brand experience that's online, our web presence, everything that we're doing to drive kind of top of the funnel pipeline. Those are things that we just need to keep investing in and see how we weather, through that. But, those are a couple things that I had, noted.
Cool. Neha, what about on your end?
Yeah, it's interesting. It's always harder to quantify on the marketing side what's working and what's not, right? It just generally with sales, it's a machine. It's a lot more predictable. When you're doing sales capacity planning, it's all just based on pipeline predictability, sales cycles, deal cycles, and the like. So from that perspective, what I think try to do is just have better alignment between what sales is focused on, what marketing is focused on in these times, to ensure that we're just optimizing everyone's talent. And what you end up sacrificing there is maybe some of the external experimental things that you do when you're looking at growth. Instead of doing the experimental things, double down on the things that are working, and then just focusing on ensuring that marketing is leaning into what the sales organization needs to be successful. Similar to Jordan, what we're not willing to sacrifice in these times is customer support, product experience. And, when we talk about net retention, that will come across really strong. It's the customer care is more important now than ever, and continuing to ensure that you're providing that good experience in good times and bad is super important. So that's an area of just kind of off the table from a sacrifice standpoint. But probably the experimental things is where we lean out a little bit in these times.
Awesome. And then a quick question came in from the audience. I'm just going to read it real quick here. How should I calculate CAC payback for hybrid SaaS volume-based businesses? For example, annual contracts with scaling monthly minimums that can be exceeded based on volume. Happy to discuss that offline, but if you're doing consumption-based where you've got contract minimums, one way we've seen it is you just calculate based on the minimum, or you also calculate based on the average overage and then adjust at year end. So it's sort of a rolling 12-month average that you're using if you're consumption-based, since it's not a fixed sort of annual contract. Okay, next question. Knowing that CAC efficiency is more important than ever in the current economy, how do you see low-touch product-led sales motion fitting into B2B SaaS? Neha, let's start with you.
Yeah, for sure. So it's interesting. This one, depending on the type of the company, the type of product, sometimes product-led works really well, especially if it's something that you can use really quickly without having to talk to a sales rep or a sales engineer. Other times it's not necessarily conducive to quick wins. But I think what's important here is that making low touch available, but making sure that the experience is really strong it's super important. That comes back to what we call care without compromise, right? So if you're going to get access to a product, but don't necessarily have a sales engineer you're working with, for example, just ensuring that the experience to get support as needed is super important. You might be able to get someone further down the funnel, so you might improve sales efficiency. But low touch sometimes works and sometimes can be challenging because it requires really, really strong support.
Yeah, Jordan.
Yeah, I mean, so one of the things that we preach at Keyfactor is a balanced sales motion and a balanced company in general, right? I think any organization that over-indexes on one way or the other, either it doesn't work out long term or they're kind of just lying to you, and it's really not. It's normally somewhere in the middle, right? And so for us, we're going to make investments in R&D. We're going to do everything we can to drive kind of a product side to the sales motion, but we're also going to invest in our resource. I'd say an example of something that's really working well for us right now is the public marketplaces. So you think about AWS, Azure, Google's marketplace. Those allow us to put either like trials or lighter weight solutions, or sometimes the full solution available right on those marketplaces, so our customers can try things out and procure right there. In fact, last year, this time, about 5% of all of our deals were done through the marketplaces. This year, second half of the year, is going to be somewhere between 33 and like 40% of all of our deals are transacting through those public marketplaces. So I think those marketplaces, give companies an opportunity to introduce a product-led sales motion that they maybe would not have had if not for those kind of opportunities with the marketplace. So, that would be my feedback, is look into that if you're not, because that is something that's really hot for our company and a big investment we've made, and we're going to keep, increasing those investments in that arena.
Yeah, and I'll dovetail into something that Neha said on that point. Look into it if you're not, if it makes sense for your business, right? I think sometimes we see companies go, oh my God, product-led growth, I got to do that. Or let me leverage channels, but it's got to be right for your business, right? Don't force something that's not, otherwise you will see efficiencies. You're going to put money into things that maybe don't work for you, but definitely it can be extremely valuable. Last question on this one, especially as CEOs, right? As you think about valuations, when do you trade off efficiency for growth beyond a certain number of CAC payback months, right? So when is it okay to have higher CAC payback because you're getting the growth, or are you always thinking about efficiency? Like if you're thinking long-term valuation for you and the company and your employees, how do you balance that? Neha.
Sure. Yeah. So it really just depends on a few key factors. And the ones that I focus on, probably at the top of the list, is customer retention. If your customer retention is strong, and we're at 98% retention, then you know that the lifetime value of the customer is really high, right? So if you have that, it's kind of okay to sacrifice a little bit of efficiency for growth, especially if you have a lot of, sales capacity that's ramping and you're kind of placing a bet on the future. So I look at probably net retention as the highest piece, and then gross margins also matter and play into it. So if you know that your gross margins are super high as well, then it kind of gives you the opportunity to take bets on efficiency on the other side, just knowing that you're going to have a longer term value from it.
Great. Jordan, anything to add?
I mean, mine was very similar, and we didn't trade notes beforehand. So, I mean, I think net retention is a really important indicator to, how much you can be inefficient, I guess, up front, knowing that you get this tail of long-term value out of a customer on the back end. And I think the rule of 40 just applies. And the other thing I would just tell a company too, it's like, if you got to look at the cash in your balance sheet, the runway you have available, how close you are to profitability, all of these things. Because if you're coming against the clock and you're, looking at, and you're staring at 18, 24 months down the line before you have to do another funding exercise, you want to start showing some returns. You want to start showing some efficiency gains, especially, now more than ever, right? You have to, show that you've got a path towards profitability. At least a lot of companies do. And so, if you are going to take a dip in efficiency, you might want to look at, when is that going to tail back? And is that going to tail back in time before I have to do another funding exercise? Because if you don't, I think that's really going to hurt multiples, when you go to do that next funding.
That's great. For those of you that are just joining us or joined us a little bit late, Pablo Dominguez with Insight Partners. We're joined here by Neha and Jordan, two of our CEOs, going into key metrics and KPIs from a SaaS perspective. We just finished talking about CAC payback and CAC. And dovetailing actually from both of your comments into net revenue retention. If you remember the McKinsey slide I showed before, the second highest correlate to enterprise value. So net revenue retention is the percent of recurring revenue retained from the prior year, including upsell and cross-sell. Also to be balanced with gross revenue retention, right? How much of your customers are you retaining, which is also extremely important. One thing we always try and coach on is you've got to look at both, right? Because you could have high net revenue retention of, let's say, 140%, but be churning customers significantly, but your upsell cross-sell is sort of masking that, right? So looking at NRR solely without looking at a balance of GRR could be dangerous. So make sure you're also looking at the retention of your existing customers, not just the expansion of those customers. So given the importance of this metric that both of you all mentioned a second ago, one of the questions that we got, so if you can elaborate a little bit more than you had before, is how do you use NRR to impact valuation expectations when you're talking to the market, investors, et cetera? Jordan, let's start with you this time.
Sure. I mean, I think, with all of these metrics, you kind of compare NRR to GRR to ASP. And I say ASP because, a lot of people will land and expand, right? They'll kind of get into an account and grow it, growing from 50 to 250 or starting at 250 and staying at 250, is still 250 in ARR. Now, ultimately you're going to, you get that kind of trajectory and you could add more in the future. And if it's just flat, that's not where you want to be, but you got to kind of look at all of it, I would say. And, NRR is really critical to our business. It's an area that, whether you're growing organically by investing in R&D and having more products to sell, if you're thinking about, your pricing strategy. For us, when I came in, it was very clear that we were kind of underserving our ability to receive value from customers for the value we were providing, because we were kind of giving a lot of stuff away up front, and we weren't putting certain gates on things and not doing it in a way to be, mean to our customer. But again, it's an exchange of value for value. So, it's really critical to us. We think a lot about it in a lot of different aspects. And yeah, I mean, I don't know how much more to say on it. I'm sure Neha's got something better than me rambling at this point. So go ahead, Neha.
No, I mean, I totally agree. And we've been, I think as you get, as you scale, it sort of changes to what you focus on. And
Right.
we're really gross retention focused at an earlier stage. We still are, and that's the 99% number. As you grow and you increase ASPs, you add more value, you're demonstrating the impact you're having on customers. That's when the net revenue retention really kicks in and the expansion kicks in. So both of those are super important. In terms of valuation, it's having that historical trend that shows if I land a customer at $250K, I know how to turn it into $1 million customer, and I've done it multiple times. And that's where like you can really have an impact on the valuation, because you've got predictability and a playbook that helps you do that. So
Right. So follow-up question from this: Are there elements of NRR that your team looks at, or you as CEOs look at, that are leading indicators to let you know that you're going to have strong NRR, expansion plus retention? Like, what are you all looking at, Neha?
yeah, I mean, this is also something that gets more sophisticated as you scale. In early days, I would say we were focused on deployment. Once you buy the product, how quickly do you deploy? What challenges do you run into to deploy? Do you hit your goals? And that's the customer success side of things, just on the relationship and the customer sentiment. And it's actually interesting. I say sentiment because it's a very qualitative metric, but it's an important one when you're focused on gross retention. As you get more sophisticated and get more insights into the product, it's product usage, it's having multiple users on the product, it's the stickiness and the number of active users. We track daily active users, monthly active users for the product. And there's trends there that you can see, sometimes seasonal and sometimes just general. But if you've got people logging in and using the product every day, you know that there's some stickiness there. And then I would say, just to like a little more generically, it's just the space you're in. If your product is business critical and core to an organization, you get the stickiness as well. And those are all tied together for indicators.
Yeah, no, that's good. Hey, Jordan, on that one, since we're getting a couple of questions on this topic, let me ask this question from one of the people who are on. How much can you operationalize learnings from upsell and NRR indications to better inform go-to-market considerations like positioning, focus, and even competitive intel? So, for example, taking post-sales lessons to better inform and sharpen top of funnel in a way that allows you to allocate outreach better.
Okay. I think I got that. I mean, yeah, from like a post-sales standpoint, we do win wires, we review the deals that we won, we do customer journey reviews to from the start of the experience to receiving value as an organization. One of the things I was going to mention real quick is that we have a big belief that there needs to be a continuous kind of value add for a customer, and it can't be this whole waterfall approach where 9 months into an implementation they're just now receiving value and it's coming in chunks. We like a more iterative release cycle, because we do sell a pretty sizable solution that takes a while to deploy. So how do we get wins along the way? I think that's really important. Back to the question about, what was the question again? Sorry.
How do you operationalize the learnings from upsell and NRR to better inform GTM considerations?
Yeah, and I'm a little under the weather, people, so sorry. But how do we use it? I mean, again, like I said, we have those deal reviews. We do win reviews. We also do loss reviews. So we have our product marketer and his team. They'll reach out to organizations that we lost deals to learn from them as to what we could have done better. What was it about the solution that we were missing? maybe something around the advisory or whatever. So there's a lot of aspects, but we can't be afraid of that stuff. And I think the question is almost the answer, which is you need to invest in learning from wins, learning from losses, and not just always moving forward, always thinking about and taking the time to pull over to the side of the road, if you will, and have a debrief and learn as to what happened, whether it was a win or a loss. I'll give it over to Neha.
No, that's great. Let me add something here because a question came in, and Neha, I would love your thoughts on this also. It goes back to CAC, but I want to give the insights perspective also around how do you calculate CAC when you first enter a new region and there's an investment of team without customer traction. I think the important thing to remember is the KPIs that you're going to download that we shared, right? Or whether you're looking at somebody else's KPIs or benchmarks, are intended to be stakes in the ground in terms of a best practice in aggregate, right? So when we talk about CAC payback, best practice is 12 months, right? Or NRR should be, 110% or above, et cetera. That is an aggregate. To answer the specific question about you're going into a new region, if you're going into a new market, country, et cetera, wherever it is around the world, you might have very high CAC payback, right? Because you've got no revenue that you're going to see for a while. You're basically incurring the cost of having the person there, and that's okay. So what's important is to look at the metrics, not only at the top level, but also to see, well, what does CAC payback look by region, right? Or by team. If you're segmented by customers, by vertical or enterprise, mid-market, SMB, you've got to look at the metrics down to see, is the aggregate number high or low because somebody's, pulling it down or pulling it up, right? Same thing for NRR. Your NRR in aggregate might be very high at 125%, but maybe in North America, it's at 101%, right? Versus EMEA and APAC are pulling it up. So very important not just to look at the aggregate number, but really to dig in and see what's pulling it one way or another.
Yeah.
Okay.
Also, if you're a organization like ours that, about 25 to 30% of our contracts are multi-year contracts, sure, we look at NRR as it relates to kind of annual kind of retention rates of our customers, but we also look at everyone that's coming up for actual contract renewal and inside of that year. So isolate down to that denominator and see what is our GRR, what is our NRR, just for those that were coming up for renewals that year, because, you could get some misleading confidence if your NRR is looking really good, but it's because your, customers are kind of locked into these long-term contracts. So you want to make sure you look at it from both aspects to make sure you're not, falsely, walking in with overconfidence in kind of your customer health.
And so given the importance of NRR and GRR, because another question came in, do you all use any specific technology out there to manage this? Or are you using your CRM, BI tools, a gain side, demand base, those sort of solutions, or 3 ops people are just crunching numbers for you? I know everybody's got a different way to do it, but question is like, what tech stack are you all using, if anything? Neha, do you want to go first?
I can. We're transitioning. So a lot of our scaling with the Series C is really about setting up new tools and operations. Honestly, a lot of what we've put together to date has been a lot of homegrown Salesforce hacks. So Salesforce is kind of core and centralized, and that's sort of the source of truth for everything. On top of that, there's, unfortunately, hate to admit it, there's a lot of spreadsheets and a lot of manual work that's gone in, and a big part of our plans for next year is to move to something less manual and start to automate a lot of it.
Great. Yeah,
Jordan, what do you use at Keyfactor?
Yeah, Salesforce is the source of truth. We do use Salesloft as well for development, but we use Domo, which has been implemented very nicely into our organization. So thanks to our team that does that. And then we also use Gainsight, and very happy with that product as well.
Cool. Yeah, and as a follow-up, since that question came up, we'll provide some of our thoughts on the entire tech stack ecosystem, because it is pretty crowded out there in terms of what is available. So we'll share that as a follow-up as well, so everybody can sort of see that. Let's go to the last KPI in terms of quota attainment. So quota attainment, for those of you that are, if you're a founder, CEO on the call, or if you're a CRO or in sales, obviously the lifeblood of a commercial organization, because that's how you determine if you're hitting your number or you're not. Pretty easy calculation. It's results over your actual target. As you look at, where reps are, it's how many reps are in certain buckets. One thing you may have seen us post from Insight this week is, what overall distributions of quotas look like. So we'll share this real quick before we actually go into some of the questions that you all submitted. So best practice, in terms of where the averages and medians are across the industry, typically you see 50, 60, 65% of total population above 100%. There's a rule of 80, where you want to target 80% of your reps or at least at 80% of quota. You might be asking, well, hey, shouldn't you have 100% of your reps above quota? Ideally, yes, it'd be great to have everybody achieving. However, you've got new people coming in, you've got attrition. So as a whole, when you look at it from a bell curve perspective, you're going to have some variability in performance. But let's go to some of the questions that came in. So as a CEO, how do you work with your CRO and CFO to come up with a realistic revenue target for next year and balance that for your reps? And I know it's a tricky question given the audience, but given some of the headwinds, Neha, how are you thinking about balancing expectations?
It's always a little bit of art and a little bit of science when it comes to this. And, annually when we do our planning, we start with our North Star, which is doubling ARR year over year, which is what we've done. Going into next year, that's where we would start and then work our way backwards, looking at all of the different factors. And the factors typically, of course, there's quota attainment, historical rep performance. There's also just trends around pipeline and predictability around pipeline. There is sales velocity, how quickly or how much have deal cycles slowed, if they've slowed. We look at ramp rep time, so just efficiency of bringing in reps and making them successful. Then there's things that are dependent on your scale, geographic expansion, just looking at all those things together, and then also coming back to how important it is to actually hit a target that's realistic and thinking about morale. So if you put all those things together, it starts with like a big chart of here's how things move around, and we kind of hone in on a range, and then we socialize that range with the other leaders and with the board. That's typically how it works.
Cool. Jordan?
Yeah, I think similar, we look at it top down and bottom up, right? So we look at what are the growth targets that we're trying to, expect to have as an organization. And then from a bottom up standpoint, I think there's some assumptions that have to be in place for your organization, which are things like, having strong confidence in leading indicators and pipeline and knowing predictability wise, what that's going to spit out, especially if you've got longer sales cycle. If you have got 6 to 12 month sales cycles, it's December 1st. So you should have some pretty good confidence in range of outcomes for at least the first half of next year. And you just got to be realistic with that stuff, right? And you got to, bad news early, right? If the reality is the top line isn't matching what you're seeing from the leading indicators standpoint, it's got to be addressed. You can't mask it. You can't hide it. That just never works out for anybody. So, my recommendation is do top down, do bottom down, hope that they meet very closely. And if they don't, then you're just going to have some hard conversations. You're going to have to present back, if you're, head of sales, you're going to have to present back to the CEO, real data information that shows, this is our RevCap model. This is kind of what we're going to, do in the next 6 to 9 months, even if we hire all these resources, and, they may not like to hear that. And so hopefully you're not sandbagging, but as long as you're being honest and realistic about it, you just have to have that conversation. But, just like in relationships, avoidance is not a good thing. So you need to address it. You need to talk through it, and you come up with a plan that works, right? Maybe it's an agreement that, hey, sales is going to be down X% next year. So we're going to have to lower overall company expenses by X%, right? So because what you can't have is an organization that's making investments, expecting sales to keep up, because if sales doesn't, that's why they say, sales keeps the lights on, right? And if sales doesn't keep up with everything else, lights start going off. And so you just want to make sure that you're having those honest and hard conversations, I would say, if the top down and bottom up isn't matching the way that you would intend it to going into the year.
Yeah, and question on this question just came in also. As the CEO, what % of your reps do you expect? Would you model finishing at the end of the year? Like, do you guys expect half of them, 60%, 70, 80? Is there a specific number you try to target given that people are coming in and out?
Sure.
Start with you, or yeah, go ahead.
Yeah, I mean, from a rep retention standpoint, we really have had almost zero attrition. So I don't think about it so much that way, but I do look at percentage of quota attainment in all of the modeling, and it falls somewhere between 70 and 80%. And so we kind of model based on that.
Yeah, for us, in my background, CRO, head of sales, it's always been 80 over 80 has always been my role, right? You want 80% of your team over 80%. So you don't want to just look at how is the company doing on a quarterly basis, annual basis, because if one or two reps is carrying it, Neha talked a lot about company morale and things like that. Like if only 2 or 3 people are hitting it, let's call that, 20, 30% of your team, that's not going to work out long-term. And that's not showing a sustainable, scalable model, right? So you've got to have, to me, 80 over 80. And if you do the inverse of that, because what we do is we essentially try to build a quota coverage of 125% on our overall target. So if you do the math, 80 divided by 0.8 is 100%, or the math works, promise, the math works. But essentially, if you have 125% coverage times 80%, yes, I think that gets you down to 100%. That's how the math works. So that's kind of how we shoot for it.
Awesome. And again, another question that came in from the audience is, the head of the company, how do you align those revenue goals between the CRO and the CMO? Are they tightly aligned? And again, also across other functions, not just sales and marketing, I guess. Neha.
Yeah, this is going to sound a little cheesy, but one of the things at Contentstack and pretty much every company I've run is it's one team, one dream, right? So you have to find a way to align around joint ownership and joint incentive. And that's, if both parties and their teams are on board to achieve the same North Star, then you get that alignment.
Cool.
One team, one dream. I love that. I mean, yeah, it's very similar, right? I mean, people, they have to show their seniority in a business if they're at the C level, or even, at multiple layers of the organization. And they've got to think about, the impact of, the organization as a whole, the cross-functional impact. We set goals and targets that are designed to be cross-functionally attainable, meaning everyone has kind of input to it. And if one team wins, another team wins. But ultimately, it also kind of lands the onus on the individual as well to kind of just level up and be more senior. And sometimes, as the organization grows and more opportunities, get presented in a business for people to take on new and bigger roles, it's a learning exercise for some individuals, right? To think a little bit broader than their team. I talk a lot about, we don't need union leaders in the business. They're, just driving, all that they need just for their group and not thinking about, the greater good of the whole company. And so, so there's a little bit of coaching that goes into it as you grow and scale. But yeah, I mean, everyone's got to be aligned to that North Star. Setting organizational targets, kind of gets it that way. So
I love that. Rule of 40, you mentioned it before, Jordan. I'll go to you and then back to Neha because this question came up. And both of you have scaled companies 50 million plus. For somebody that's scaling from 50 to 100 million, is there a percent of the rule of 40 that should be revenue versus profitability, or does it depend on the business? Like what have you seen work?
I mean, I just think it really depends on the business. It depends on the cash position. It depends on the confidence in your investors and the availability of future, infusions if you need it. It really just depends on how long your road is, right? Because at the end of the day, you've got to come up for air, right? And you've got to come up for air from a profitability standpoint. If you're growing really fast, but it's not profitable and there's not an end in sight, then you better be very closely aligned with your investors as to when that will bounce back, because it doesn't last forever, right? There's a time where you've got to show the profitability. It's different for different companies. I would say, for us, we're experiencing not as fast of growth as Neha's team, but for us growing 50 to 60% a year, that we're getting to the point where we're approaching 100 million ARR, where, we do want to make sure we're showing kind of those profitability and in that path to a cash flow positive business. And so that's, so it's different for different companies, I would say.
Yeah, anything to add or?
Nothing really to add there. I mean, I think you got it all, Jordan. And it's just efficiency is a focus area. So as long as your sales and marketing spend is efficient and you're watching that closely, then I wouldn't say that there's a rule.
Yeah, fully agree. And I think you mentioned it before, Neha, and I love how you run your businesses, right? Like you mentioned before, you're always thinking about sustainable growth, efficient growth. And I think if you have that in mind, you're right. There is no formula for, hey, when you're at 50 or 75, here's what the mix should be. We've seen even public companies, right, like a Snowflake, that have significant growth with lower profitability. It just depends on what the mix is on where you are. So, well, thank you both. This has been great. As a recap to everybody, we went through 3 of the metrics: CAC and CAC payback, NRR and quota attainment. One thing I did want to call out is we will be sending out a recording to all of you, and also with the link for the Scale Up by the Numbers report. You can access it right now if you wanted to on insightpartners.com and go to the blog section. You can see the picture below, and we will give you all some time back. Every time I join a webinar, I'm always worried that it goes right up to the moment. So if you could just take 2 seconds to answer the 3-question survey that the team will send out right after, we would really appreciate it. And happy Q4. Good luck, everybody, closing out the quarter, and have happy holidays.